It's time for the Trading Stocks Made Easy podcast. Each week, Trading Stocks Made Easy demystifies stock trading and investing so you can profit big. And now, here's the host of Trading Stocks Made Easy, the wealthy investor, Tyrone Jackson.
Hey everybody, it's Tyrone Jackson. I'm back with a new episode of Trading Stocks Made Easy. This is episode 233, Stock Split Secrets. I don't want to waste a lot of time, but I want to get to it. Okay, so you know how I'm always teaching and encouraging you to put your money in the stock market, to use an established methodology for trading, which we call affectionately the wealthy investor approach, and don't deviate from that discipline, right? Right. If you are choosing stocks that pay a dividend, you're engaged in covered call writing, and all of the things that I teach you, you'll fall in love with a system. So frequently, I like to say, as a member of the wealthy investor community, you are a systems trader and a systems investor. Systems on Wall Street means you're going to do the same thing over and over and over without too much deviation and get spectacular results, right? All right. Well, in every system, there are some nuances, right? Details, an approach that only you're going to use during a bull market. There are approaches like buybacks and resells on the option side that we use in bear markets. And then one of my all-time favorite strategies, which I have to admit has been dormant for a little while, but has now returned, which are stock splits. All right, I haven't spoken about them in a while because the market conditions have not lent themselves to, well, mastering stock splits. So I call this episode Stock Split Secrets, things you might not know about the stock market and why companies split their shares. Now, in order to be a good, wealthy investor student so that you can make lots of money in the stock market, I'm going to ask you to keep an open mind right now. Even if you think you understand why companies split their shares, just listen to this episode thoroughly from beginning to end. So let's dive right in. Okay, so as stocks rise in the market, one of the options or choices that the board of directors have at its disposal along with the CEO is when the shares get too high, they can split the value of the shares either in half, in thirds, and in various combinations. In other words, a company's doing very, very well. Therefore, there's demand for their stock, right? That demand for their stock, particularly institutional investors wanting to buy more and more shares, millions and millions of shares as the stock price rises, that demand can ultimately cause the stock to become out of reach for the retail investor, people like you and I. There are some companies that reward their employees with shares in the company. But if the stock price continues to rise, it becomes more and more expensive on a per share basis. So the board of directors, along with the CEO, but mostly the board of directors who make policy at the company, can decide to split those shares. So if a stock, let's say 5 years ago, was trading at $200 a share, it is now at $600 a share. The board will say, hey, our shares are getting pretty pricey. Why don't we cut the price in half and split the shares 2 for 1? So every share of stock that you currently own at 600, when the stock price goes down to half the price, you will own 2 shares. Now, the most common stock split and the easiest to understand is a 2 for 1 stock split. But stock splits come in various combinations that are frequently understood by Wall Street. So 2 for 1 is very common. 3 for 2 is very common. And then there are a few other variations in between. But generally, when the policy-making committee, board of directors, decides to split the shares, they really want the price to be lower and more accessible to the retail investor. That's number one, okay? Another reason why a company splits its shares, because quite frankly, they compete with each other on an exchange. So if my share price was, let's say, $900 per share, and I decided to do a 2-for-1 stock split, my share price would go down to $450. Now, here's the key. You don't really get anything big out of a stock split. It just reminds me when I was in the third grade and we used to sharpen pencils at the pencil sharpener. If I broke my pencil in half, and it would appear that I have two pencils, right? But the reality is I just broke one pencil in half. I have two writing implements, if you will, but it's really just one pencil. Well, on the most common stock split, if you're a covered call writer, that makes a big difference. Because now if I have more shares, I'm getting closer to 100 shares of stock that allow me to now cover call write on a stock that was twice the price, and it was harder to get 100 shares. So in one sense, when a stock splits, you're not really getting anything out of it other than if you have 50 shares, you now have 100 shares, and now you can start our favorite income generating strategy, which is selling out of the money covered calls. So there's a lot of theoretical ideas around stock splits that say it doesn't really help the average shareholder. So I'll leave that debate to Wall Street technicians. But let me tell you what happens for covered call writers. It makes shares more accessible for us. Okay? So if you have a $20,000, $30,000, $40,000, $50,000 trading account and a company splits, obviously you can buy more shares because the shares are half the price. That stock can now become an income generator for you. So what I love about stock splits is, particularly 2-for-1, is you get twice as many shares, or I may start a brand new position in a company that I've never owned before because the shares were simply too expensive for me to employ my particular income generating strategy. Okay? So we've got the board who makes the shares a little bit more accessible so their employees can be rewarded by buying shares at a discount to what's happening in the open market. And if the shares are too pricey, the employee is simply not going to get the benefit of that. Secondly, if you're a covered call writer, stock splits are very important to you because it allows you to start a brand new trading approach to a company that simply was just too expensive. Now, here's the third reason, and this is not talked about very often. When a company splits its shares, pension money and retirement money, which is coming from pension funds and mutual funds, finds its way into the stock. In other words, if the revenue's there and it's a great company, retirement and pension money makes its way into the stock because it's much more appealing to the pension fund manager. See, all of these elements, the retail investor, the board, and the attractiveness to pension funds, creates demand. So sometimes you'll look at a stock and you go, well, it's moving pretty nicely. They announce a 2-for-1 stock split. The stock suddenly goes up, splits, usually sells off at first. A lot of people miss that. And then starts its journey right back up to where it was before it split. Why? Because the pension funds find it really attractive. That's number one. Number two, retail investors find it really attractive. And number three, employees can now choose to buy shares either from the open market or at a slight discount to the open market, and it causes those shares to rise. Now, here's one nuance that no one talks about, and I want you to understand this. This particular nuance of a stock split involves index funds, okay? So, for example, when a stock is rising, and we don't talk about this too much because it's not really part of our approach, its market cap also rises. So as those shares are going up, their value, their theoretical value to the market goes from 50 million to 200 million to $500 million. That market cap can get a company included in a particular index that is market cap weighted. Now, I know that's a lot to think about, but when a company announces a 2-for-1 stock split, some indexes, like the S&P 500, may wind up picking up additional shares if the company qualifies, based on market cap, to be in that index. Now, typically, typically, when I'm teaching, I tell people to pay attention to two indexes only. The Dow Jones Industrial Average, which you know includes 30 stocks, and the S&P 500, which includes the Dow and 470 other companies, right? Okay. Now in the history of the market, we've never had so many smaller indexes that follow the market, and there are indexes for sectors. So there's a financial index, there's a semiconductor index, right? There's a construction home builders index. So with all of these indexes, and what is an index? It's a series of criteria for which a stock can qualify and be traded on by a mutual fund. So most of the indexes are followed by mutual funds. So take the Russell index, for example, which is supposed to track primarily tech stocks. If your stock splits and it becomes a higher market value, it can be part of that index. So that means that that index has to buy a certain amount of your shares to mimic or wait out the index itself. So I'm going to go through some stock splits here in a minute, and I'm going to tell you that some of them are now going to be held more by index funds. See, this is how stocks create demand. If you did not have this financial education, you would not understand the benefit of a well-received stock split. Not only does it create demand for the stock, when demand goes higher, the shareholders reap the benefit, obviously. And who are some of the largest shareholders? The board of directors. See that? So if you look at any CEO on Wall Street, if they're the CEO of a publicly traded company, they're probably starting at about $5 million. But how are they compensated? They're compensated based on how well the stock and the company does. So although their annual income may be $5 million, they may have $30, $40, $50, $100 million worth of stock. And when that stock price goes up, what happens to the value of their assets and their net worth? It goes higher. In case you didn't know, certain CEOs are heavily compensated with shares. If those shares are in demand and that stock price starts to rise, they get richer and richer and richer. So let me drop this one on you. And remember, when I talk to you, I'm trying to keep everything in layman's terms, although it's hard because sometimes I have to go over into Wall Street terminologies. No avoiding that, right? Okay, so stock splits represent tremendous amounts of potential for the board of directors and for the CEO because they're all compensated, not necessarily in cash, but in stock. So that means that if you are smart, you want to create a condition where Wall Street is paying attention to your stocks and buying millions and millions and millions of shares because that's how you get richer, right? Okay, so if the company offers the right stock split, everybody involved who are millionaires become billionaires, billionaires become multi-billionaires if the stock split is planned accordingly. And here's the key. If the company has strong revenue growth and you split those shares are going to go right back up to their pre-split level somewhere between 5 and 7 years. So let's talk about the people who got rich during the software and technology revolution when Apple and Microsoft were splitting their shares every 24 months. That split means what? That they were able to do what? Create more wealth, more demand for their stock. And don't forget, the company actually owns millions and millions of shares that they can sell back to the open market, right? Right. So everybody benefits from a well-planned stock split. Don't buy into the classic Wall Street argument that, well, it really doesn't mean anything. Really, it means a lot to everybody who's owning those shares on the retail side, on the pension side, and everybody who's compensated by shares in the open market. It is a big deal. So what does that mean? That you and I are looking for patterns in stock splits that help feed our 401k, our retirement, our cash account, our margin if we're trading, right? So if you are patient, smart, and educated, the right stock split means the world to you. So let's talk about some companies that recently split their shares and will be splitting their shares in the future so that you can benefit. Right after you listen to this.
Want to increase your stock market trading profits? Then you need to start your monthly membership to WITradeschool.com right now. Don't understand how to write covered calls for monthly income? No problem. Simply review Tyrone's latest stock trades in our video library as many times as you need. WITradeschool.com is all about helping you get the financial education you need to earn money in the stock market and change your financial life. Tyrone Jackson, the wealthy investor, has helped his students earn thousands of dollars per month trading stocks online from home. These are people just like you. So what are you waiting for? Follow Tyrone Jackson's red-hot stock trades and investment strategies today. Don't wait. Start your monthly membership at WITradeschool.com right now.
Today's episode's all about stock splits and stock split secrets, being in the know, indexes, and market caps. Well, let's get back to the fun stuff here now so that you can understand how this all plays out. So if you look at the history of Microsoft, how many times have they split their shares? Well, it's happened at least 10 times since they went public. That's one reason why Bill Gates is a multi-billionaire, because he split his shares so many times. So someone's going to go, well, why not split the shares every year? Well, that is not going to fly, because if the revenue from the company's not there, nobody's going to keep buying your shares just because they're cheap. You still have to stay focused on your business, on your revenue, and doing a great job for shareholders. So you're not going to get a stock split in your favorite company every year, but every 5 years, possibly, depending upon market conditions. So let's just look back at a little bit of history. We know not too long ago, Google split its shares, and not too long ago, Apple split their shares. But I like the Amazon stock split that happened on June 6, 2022, because the shares are up 80% since they actually split. Now, that Amazon split, I said to everybody in the program, you got to prepare yourself for that. And we took a specific strategy that I recommended, and no one has complained because they've done very well. If the shares are up 80%, how about the derivatives? How do they do? Well, that's another discussion for another time. But if you look at Amazon shares, their last split was 20-for-1. That was historic, right? All right, let's look at a Dow stock that also split, which is Walmart. Walmart split its shares February 26, 2024, 3-for-1. Now, Walmart has never really excited Wall Street, simply because Wall Street is most excited right now by technology stocks. But the shares did split down to about $50 a share, and they've been in a range for a little while since their split. I think the shares would have done much better if Walmart changed its name to Walmart AI. Then the market would have said, oh, they're in the technology business. They would have done very, very well. But that's not going to happen. Do I think the Walmart shares will be higher than where they are now in 5 years? Absolutely. The shares tend to go up 80 to 90%. They're doing a fantastic job over there on marketing. And one of the strategies that they talked about in the last press release was they discovered that in this era of streaming, families actually like to leave their home and have day trips. And where do they have day trips to? Believe it or not, Walmart. So Walmart has started setting up what they call in-store advertising on monitors. So you bring the kids with you. We're just going to take a quick trip to Walmart. And the kids are seeing all these toy commercials on the monitors. And they're saying, hey, you can get this toy right now in aisle 26. And it's working. Not just for toys, but anything they want to put on sale that day. They're noticing that these in-store promotion on these monitors, essentially people watching TV while they're shopping, boosts the sales at stores across the country. I didn't make it up. This is what they said. So what they're planning on doing, they want there to be a Walmart every 50 miles. Now, this is really interesting because who would ever think of a trip to Walmart as like an outing for a family? I could tell you this, my daughters are now grown women, but when they were younger, we would do the same thing with Target. We'd go to Target because, you know, you can get the popcorn and the whole thing. The kids loved being out, seeing all the merchandise, and it was just something spectacular to do. In essence, it was free, but it wasn't really free because when I left Target, I always left with a bunch of things in my cart, and my daughters left happy. So streaming, although we can watch these movies at home, there's nothing like getting out, even if it's to Target or Walmart. All right. Now, here's the real reason for this show. If you know me, you know I'm going to talk about ticker symbol CMG, which is Chipotle. Now, Chipotle is doing something that is extraordinary. It is the largest stock split in the history of the New York Stock Exchange, 50-for-1. The most popular stock split I talked to you about was 2-for-1, 50-for-1. At the time of this recording, those shares were trading at $2,900. They're going to split into shares of about $60. Now, how did we miss the run-up, right, in Chipotle over the past 5 years? Well, anybody who knows anything about the float size, the float was so small, and the company was only promoting itself to institutional investors. The retail investor really didn't learn a lot about Chipotle. Their public relations were down. They didn't have these fancy media managers the way that they do now. And boy, is that stock split being promoted. Now, here's the key. The stock splits 50-for-1 on June 26, 2024. Those shares are going to take off, not initially, in my view, but in the first year post-split. I expect those shares to sell off. There'll be an awful lot of profit taking in the first 2 weeks that the shares actually split. Mostly institutions selling off their shares. That's going to drive down the price. They're going to pick up the price of the shares cheaper and ride the new wave. The other thing that's interesting is that Chipotle, based on the size of this split, has a high probability of being added to certain indexes, whereas it wasn't before. So all of these things are going to create demand for the stock and ultimately drive the stock price higher. Now, if I were on the board, I would have a whole public relations campaign targeted towards the financial press, promoting the split and the success of the company. And I'd probably run even more TV spots because, let's face it, that's where my wealth is. It's in the stock price. Now, this is not artificially driving up the stock price. You're just celebrating the good news that's coming out of the company anyway and promoting it to the public, Wall Street, and pension funds. Now, here's what I see happening, and this is going to be so interesting. That stock split is going to attract a lot of pension money so that within a year or two, I think Chipotle is going to add a dividend. Institutions love dividends, and that stock is going to go right back up in a 5 to 7 year period to where it was before it split. The other thing that's going to happen, I think this is going to encourage a lot of other stock splits in the fourth quarter because companies, let's face it, compete for Wall Street investor dollars. They're really competing for pension dollars. He's talking about billions and billions of dollars devoted towards someone's retirement, and that money tends to be long-term. So some of you are going to look at this Chipotle split and say, a chance to get rich. And you're going to be wrong, and you're going to get discouraged. You're going to hold the stock for 6 months. You go, this doesn't work like Tyrone said. Well, I'm not talking about a 6-month period. I'm talking about a 2 to 5 year period to reap the benefits of the stock price rising significantly. Because although Chipotle probably didn't have a big public relations staff, I would not be surprised if they've just hired a new firm. Why? Everybody wants the stock price to rise, and everybody wants the benefit of choosing a winning stock. So, if you stay with the Wealthy Investor Program, as this plethora of stock splits take place in the fourth quarter, say that 4 times fast, by the way, not as easy as you think, I will guide you through which are the better stock splits, the ones that I favor, and sometimes we get some junk stock splits. Companies that split their shares, the revenues are not there, but they want the attention from Wall Street. It never works. It just never works. So if you want to know how to choose good stocks that are splitting, if you want to know how to choose good stocks in a bull market and over the next 6 months, then the Wealthy Investor Program is for you. Everything I do here is for you, and I try to keep all of this explanation and terminology very simple. It's not all very simple, but I strive to do that so that even if you have $5,000 invested in the stock market, you learn how to pick based on a financial education. For those of you who have $500,000 in the stock market, you know this program and this system works. And when there's a topic worth discussing, I'm going to be the first person on the internet to explain it to you. Hey, listen, I know a lot of you have been doing this. If you feel that this show helps you, share it with your friends and your family. Send a link, post a link on Facebook, post a link on Instagram, and let people know that this financial education is available to them. And this is what I love about this digital era. Never before in the history of the stock market has there been such an opportunity to learn how to trade and invest, in many cases, for free. So you are getting that education here. If for some reason you have not downloaded the latest version of the Wealthy Investor Stock Trading ebook, which has some of my favorite picks in it, what are you waiting for? Just go over to thewealthyinvestor.net. And in some cases, depending upon how you participate in the program, you know I actually send you trades. Now, how much easier can it get? Let me send you the profitable trades when you upgrade your membership there at WI Trade School. Thanks, everybody, for joining me here today. I'll keep you apprised of the latest stock split and all the action that's going on in our stock market, because my job is to make as many millionaires as possible based on the information that I share with you. I'll see you right here on the next Trading Stocks Made Easy.
You've been listening to the Trading Stocks Made Easy podcast. Be sure to rate and review our show on iTunes. While you're on iTunes, be sure to click the subscribe button and you'll automatically receive our next episode.